Listen to me. If you are approaching retirement, or if you are already there, you have a massive bullseye on your back. And that bullseye is colored green, because the IRS is looking at your hard-earned savings and they want their cut. You have spent decades, saving this money, but if you don't have a plan for how to take it out, you are going to lose a fortune to taxes. I don't want that for you. You worked too hard for this money to let it just slip through your fingers because you didn't know the rules. The biggest fear I hear from people like you is the fear of outliving your money. But what people don't realize is that taxes are the silent thief that makes that fear a reality. When you were working, you were in a rhythm. Now, the rhythm has changed. You are in control now, and that is a powerful thing, but it is also a dangerous thing if you are careless. You need to understand that every dollar you withdraw is not created equal. So, I want you to listen to me very clearly. We are going to talk about 10 legal, ethical, and smart ways to reduce your taxable income. This isn't about tricks. This is about being a master of your own financial destiny. Strategy number 1, the Roth conversion. This is a big one. Many of you have all your money sitting in a traditional IRA or a 401k. Every time you take $1 out of there, it is taxed as ordinary income. But right now, you might be in a tax valley, that period after you stop working but before you start taking Social Security or your required minimum distributions. This is your window of opportunity. You convert some of that traditional money into a Roth IRA. Yes, you pay taxes now, but you pay them at today's rates, which are likely lower than they will be in the future. Once that money is in the Roth, it grows tax-free and comes out tax-free. You are locking in your tax rate and saying to the IRS, you can't touch this ever again. Number 2 is the Qualified Charitable Distribution, or the QCD. If you are over age 70 and a half, listen to me. If you want to give money to your church, your synagogue, or your favorite charity, do not, I repeat, do not take the money out of your IRA, put it in your bank account, and then write a check. Why? Because that withdrawal counts as taxable income. Instead, you tell your IRA custodian to send the money directly to the charity. It satisfies your required minimum distribution if you're of age, and it never shows up as income on your tax return. It's a win-win. You help the world and you keep your income down. Number 3, tax loss harvesting. If you have money in a regular brokerage account, not your retirement accounts, and you have some investments that have lost value, don't just sit there and cry about it. Use them. You can sell those losers to offset the gains from your winners. If your losses exceed your gains, you can use up to $3,000 of that excess loss to offset your ordinary income. It's about taking a bad situation and making it work for your bottom line. Strategy 4, look at municipal bonds. If you are in a high tax bracket, why are you paying federal taxes on your bond interest? Municipal bonds are often exempt from federal taxes, and if you buy bonds from your own state, they might be exempt from state taxes too. Now, you have to look at the tax equivalent yield to make sure it makes sense, but for many of you, this is a way to get income that the IRS simply cannot touch. Number 5, the Health Savings Account, the HSA. I call this the triple tax threat in a good way. It is the only account where you get a tax deduction for putting money in, the money grows tax-free, and it comes out tax-free for medical expenses. If you are still working and have a high-deductible plan, max this out. Even if you're retired, if you have money left in an HSA, use it for your Medicare premiums or long-term care insurance premiums. It is the most tax-efficient bucket of money you will ever own. Number 6, managing your Social Security timing. Did you know that up to 85% of your Social Security can be taxable? If you have too much other income, from part-time work or IRA withdrawals, you trigger a tax on your benefits. By delaying Social Security and living off your taxable brokerage accounts first, you keep your provisional income low, potentially keeping your Social Security tax-free or at least reducing the hit. Number 7, the 0% capital gains rate. This is a hidden gem in the tax code. If your total taxable income is below a certain threshold, and for 2026, those numbers are quite generous for married couples, your long-term capital gains tax rate is 0. 0. You could sell a stock that has doubled in value and pay absolutely nothing in federal taxes if you stay within that bracket. This requires precision. You have to monitor your income like a hawk, but the reward is massive. Strategy 8: Asset location. Not asset allocation, location. You need to put your tax-ugly investments, like high-turnover mutual funds or corporate bonds that pay taxable interest, inside your IRAs where the tax is deferred. Put your tax-efficient investments, like index funds or stocks you plan to hold for a long time, in your taxable brokerage accounts. Where you hold your money is just as important as what you're invested in. Number 9. Consider a QLAC, a qualified longevity annuity contract. This is a way to take a portion of your IRA, up to $200,000, and move it into an annuity that doesn't start paying out until you're 85. The beauty? That money is removed from your required minimum distribution calculations. You are literally deferring the tax even longer and insuring yourself against the risk of living too long. And finally, number 10, move to a tax-friendly state. I know, you love your home, you love your neighbors. But if you are living in a state that taxes your pension, your Social Security, and your IRA withdrawals at a high rate, you are fighting an uphill battle. Sometimes, a move of a few hundred miles can save you thousands of dollars every single year. Now, listen to me. This is your life. This is your money. The actionable takeaway here is simple: do not wait until April to think about this. Sit down with a tax professional who understands retirement, not just someone who enters numbers into a computer. Ask them about these 10 strategies. Be proactive. Because if you don't value your money enough to protect it, the IRS certainly won't do it for you. You have to be the one to stand up and say, I worked for this, and I am keeping it. You can do this. Stay safe, stay strong, and stay secure.